A short-term, constructive turn in Bitcoin? Trump has continued to scale back his tariff threats, with each retreat reinforcing the perception that China's assertive response caught him off guard. He's lending credibility to critics, who argue that the trade standoff may be more theatrical than strategic. Despite the political noise, consumer confidence remains subdued and recession risks persist, especially if inflation resurges and credit spreads widen. This suggests the market could be entering a prolonged corrective phase, during which the Federal Reserve will likely stay on hold. However, stronger than expected retail spending data, reflecting pre-tariff announcement behavior, due next week could temporarily boost sentiment. Meanwhile, Bitcoin's technical outlook has improved, with several indicators turning more constructive. Bitcoin is now breaking above the downtrend that has persisted since Trump's inauguration. 3 key reversal indicators have turned bullish, with the RSI notably climbing above 50%, a signal of strengthening momentum. We've also observed a positive divergence between the RSI and Bitcoin's price action. While Bitcoin made a lower low, the RSI did not follow suit. This is commonly interpreted as a bullish divergence, signaling potential upward momentum. The trend model turned bearish on February 1st at $97,000 and has remained negative until now. It has just flipped bullish, with a stop set at $74,000. The 21-week moving average, currently at $86,694, remains a key level for determining whether Bitcoin is in a bull or bear market, and it's now on the verge of a potential flip, signaling a possible trend shift. The market structure remains fragile and will likely stay that way as we enter the seasonally weak summer months, when Bitcoin historically tends to consolidate. Tariff-related headline risks are expected to persist, and the current wave of soft economic data, particularly from sentiment surveys, will likely begin to show up in complex data, signaling broader economic weakness. The U.S. tech sector has already come under pressure due to concerns over reduced spending from hyperscalers, a trend that could continue to weigh on market sentiment. With the Fed expected to stay on hold for the foreseeable future, this is likely not the environment for a parabolic move higher. In this context, not every investor needs to take an active position. While we've maintained a bearish bias, our preferred approach has been selling options, both calls and puts, as Bitcoin will likely remain in a broad trading range, $73,000 to $96,000. The $73,000 level continues to act as strong downside support. In February, we argued that Bitcoin could outperform equities during a broader market correction, despite its historically high beta to the Nasdaq, due to the emergence of a new class of buyers. Specifically, while its holding between 100 and 1,000 BTC, $8 million to $80 million, had overtaken the historically dominant OG wallets holding 1,000 to 10,000 BTC. We believe these newer holders are primarily family offices, asset managers, and wealth managers, accumulating Bitcoin with a long-term diversification strategy in mind. This shift in ownership has proven significant. While short-term holders were shaken out when Bitcoin dipped below $92,800, there was no widespread rush to sell once Bitcoin dropped below $80,000. Current holder distribution remains largely in profit, and with leverage at subdued levels, selling pressure has been minimal. Bitcoin stands out as a compelling option in an environment marked by a weakening U.S. dollar and the potential introduction of capital controls. As a result, Bitcoin has now broken above its downtrend line, shifting the bias from downside risk to a cautiously bullish outlook, though we expect any upside to be measured rather than explosive. The major buyers behind the September to December 2024 rally, wallets holding 100 to 1,000 BTC, have not resumed their accumulation. This lack of renewed buying activity suggests that upside potential may remain limited. Therefore, traders must balance a short-term constructive outlook with a more cautious medium-term perspective, where factors such as the Fed's stance, widening credit spreads, weak consumer sentiment, and elevated uncertainty continue to weigh on asset prices. This tension is also evident in the growing divergence between short-term and long-term technical indicators.